This hearing will come to order. This hearing is in hybrid format. A few reminders as you begin for our guests who are joining us virtually. Once you start speaking, there is a slight delay before you're displayed on the screen. To minimize background noise, please click the mute button until it is your turn to speak or to ask questions. You should all have one box on your screen labeled clock that will show you how much time is remaining. For witnesses, you'll have 5 minutes for your opening statements. For all senators, the 5-minute clock still applies for your questions. At 30 seconds remaining for your statements and questions, you're going to hear a bell ring to remind you that your time has almost expired. It will ring again when your time has actually expired. And to simplify the speaking order process, Senator Kennedy and I have just decided we'll go by seniority as people come in. What we're going to do is we're also in the middle of votes, just to add an extra layer of complication to all of this. So I am going to hand the gavel over to Senator Kennedy, who's going to get us started. I'm going to run vote, and then I'll come back, and he can do the same. So thank you all for being with us. Thank you. Thank you, Senator Kennedy. All yours.
I don't have a very elaborate opening statement. I want to thank all of you for being here. If there are problems in our private equity markets, I would like to hear about them. I consider private equity, and we can talk about the definition today if you'd like, to be an essential part of the free enterprise system. I mean, stripped to its bare essential, all a private equity investment is a decision by one willing buyer and one willing seller. And that happens every day, billions of times every minute in the American economy. Private equity, as we know it, as I know it, of course, is limited to accredited investors, very sophisticated investors. I'm a former state treasurer and sat on the boards of a number of retirement systems. I know in the retirement systems with which I'm familiar, private equity is a huge part of those retirement systems investments. So put me in the corner of pro-private equity. But certainly I say that because I'm pro-free enterprise. I'm not real fond of neo-socialism. I think neo-socialism is just trickle-down poverty, and it bothers me that our store shelves are starting to look like the store shelves in Cuba and Venezuela. That concerns me a great deal. So let's get started. I can't see without my glasses, and even with my glasses, I can't see that far. Okay, I'm not going to introduce the panel. That'll just take away from them, from their time. I'm just going to introduce the speaker. Well, maybe I should. I don't know. I don't want to get put on double secret probation here. Okay, first, I'm going to read this. Joining us virtually, we have Ms. Shirley Smith. Ms. Smith is a former employee of Art Van Furniture in Detroit, Michigan, and is a leader with United for Respect. Next, here in person, we have Ms. Peggy Malone. Ms. Malone is a registered nurse at Crozer, did I say that right? Chester Medical Center in Upland, Pennsylvania. Joining us virtually, we have also the Honorable Frericks. Did I say that, Mr. Treasurer, correctly?
Senator, former Treasurer, close up, Michael Frericks.
Yes, sir. Mr. Treasurer, welcome. We also have Dr. Eileen Appelbaum here, who's the co-director of the Center for Economic Policy and Research. And we have Dr. Doug Holtz-Eakin, president of the American Action Forum. And lastly, we have Mr. David Burton, senior fellow at the Heritage Foundation. Let's start Well, let's start with our panel here. How about Mr. Burton?
Thank you. My name is David Burton. I'm Senior Fellow in Economic Policy at the Heritage Foundation. I'd like to thank you, Senator Kennedy, Senator Warren, and the other members of the committee for the opportunity to be here. Entrepreneurship is vital to innovation, improved productivity, better products, better wages, and prosperity throughout the country. Private capital markets are by far the primary means by which entrepreneurs raise capital to launch and grow their business. Private equity, broadly defined, is absolutely vital to the economic future of the United States. Private offerings account for at least $2.9 trillion annually in capital raised. In contrast, registered or public offerings raise less than half of that amount, $1.4 trillion. Regulation D is the most important means of raising private capital and accounts for approximately $1.7 trillion as of 2018. Now, public capital markets are in decline due to regulatory overreach. Firms go public much later in their life cycle. Fewer firms go public at all, and ordinary investors typically do not receive the returns from successful startups and entrepreneurial ventures because they go public so much later. Being a public company has become extraordinarily expensive, both in terms of the initial public offering costs, the amount of money you have to spend on lawyers, investment bankers, accountants, and so on, but also the continuing compliance costs and the annual regulatory costs, not to mention regulatory risks, the threat of being sued. The number of public companies has declined almost by half over the past quarter century, despite the real GDP growing by 80% and the population increasing by almost a quarter. There's a major effort underway now to apply the policies that have harmed the public market to the private market on a whole host of fronts, including ESG and on what have you. And the legislation that is part of this hearing today would be part of that, the Stop the Wall Street Looting Act. Private equity funds, narrowly defined, are also an important aspect of our capital markets. They're one of the primary means of keeping incompetent management accountable. They also are one of the primary means by which companies are turned around by an infusion of new equity capital. The Stop Wall Street Looting Act would be more aptly named the Protect Incompetent Management Act. It basically would erect a high wall and a moat around the management of companies that are failing and make it virtually impossible to mount a takeover that would be able to change the management and protect the continued existence of the company by replacing the management and also protecting the employees' jobs who work there and will lose their jobs in the event the company fails. Now, this may be attractive to corporate elites and corporate management and their lobbyists, but it's certainly not in the interest of shareholders, workers, or consumers. One thing I wanted to bring to the attention of the committee, if you read the section by section, there's a provision that imposes a 100% tax on fees paid by target companies to private equity funds. But the actual statutory language in that would, in effect, impose the 100% tax, which is really including state taxes, more than 100%, on all payments by firms to any fund. It's very poorly drafted language, and not only would shut down in effect the private equity market, equity fund market, but have much broader and extraordinarily adverse effects. I think that's a drafting error, but it's a really important drafting error. Other things in the Act that I think are deeply problematic, Title V would impose disclosure requirements on private equity funds that are roughly comparable to what Regulation SK and other aspects of the securities law impose on publicly traded funds. And I think that's more or less by design. It would impose disclosure requirements on private equity firms that are roughly analogous to public companies, so no one would actually choose to be a private equity fund anymore. Shutting down these private equity funds would have an adverse impact on millions of people. And lastly, in my written remarks, I include 14 specific suggestions on how to improve our private equity markets. Thank you very much.
Thank you, sir. Dr. Holtz-Eakin.
Well, thank you, Senator Kennedy, Senator Reid, members of the committee, for the chance to be here today. I also don't have an elaborate opening statement. Let me say a few things, and then I'd be happy to answer your questions. Clearly, financial markets are an important part of the U.S. economy. They serve to provide many essential economic functions, channeling funds from savers to investors, allocating that capital as efficiently as possible, pricing risk and return, allowing individuals to diversify away from risk as they desire, and the list goes on. And in looking at those financial markets, you'd like to have all sorts of business models compete to provide those services to the economy. And we have insurance companies and banks and all sorts of things, including private equity. My concern today is about the proposed legislation. And I'm concerned not because I'm a big fan of private equity. I'm not. I'm also have no particular animus toward private equity. I'm concerned because the legislation would tilt the legal, regulatory, and tax playing field quite strongly against private equity. And I think that the objective of policy should have that those legal, regulatory, and tax policies be as neutral as possible. This is clearly an attempt to tilt the playing field against private equity. And if there are now, sort of problems with the private equity, I think those should be dealt with in other ways, identifying the harms and correcting the behaviors. So its success in finding undervalued companies, reforming their operations, has delivered an enormous footprint. Right, there are 11.7 million workers in private equity, earning about $900 billion in compensation. These are good-paying jobs. The average employee is getting $73,000 in 2020, and the private equity sector has produced $1.4 trillion in gross domestic product, or about 6.5% of GDP. That footprint is a testament to the success it has had in providing valuable economic functions. The flip side is that this legislation would undo that, and that would come at a tremendous cost. The Chamber of Commerce estimates that the loss would range from somewhere between 6.9 to 26.3 million jobs in the U.S. economy, and returns that are up to $3.5 billion a year for investors. And so my hope is that the discussion can focus on what is good policy for private equity and others, and where there are, in fact, identifiable harms, to find remedies that aren't so sweeping as to disrupt the level playing field from a policy perspective. Thank you.
I'm going to turn the gavel back over to our It's a story of my life. So we're next. I thought I would leave the virtuals to the end, but I shouldn't have done that.
Okay. That's okay.
The treasurer's next.
So it looks like we have the Illinois State Treasurer next, the Honorable Michael Frericks. Michael, are you there?
I am. Can you hear me?
Thank you. Yes, we can.
Great. Well, good afternoon, Madam Chair and Ranking Member Kennedy, members of the subcommittee, and distinguished guests. Now, the clock I am looking at shows me 1 minute and 30 seconds. There we go.
There you go.
My name is Michael Frericks. I'm the Illinois State Treasurer, elected by the great people of the state of Illinois. And as Senator Kennedy knows from his time as State Treasurer, and my colleague in the National Association of State Treasurers, it is truly an honor to be entrusted with the people's money. It is an honor to be invited to speak with this subcommittee today. The Illinois State Treasurer performs many roles. I'm the state's chief investment and banking officer. In that role, my team and I actually manage approximately $50 billion. This portfolio includes roughly $25 billion in state funds, $16 billion in retirement and college savings plans, and $9 billion on behalf of local and state governments. Among those investments are $500 million in private equity and venture capital. But I also serve as a trustee on the Illinois State Board of Investment, which manages approximately $31 billion in pension assets on behalf of over 226,000 beneficiaries. ISB maintains approximately $1.7 billion of private equity investments. My job is to prudently invest public funds and pension funds, a portion of which are managed by private equity firms. I also have a responsibility to the long-term fiscal health of our state and local government institutions, which rely on a vibrant and sustainable economy. And I also have a duty to tend to the well-being of the communities I represent, including the economic security and dignity of millions of workers. Unfortunately, some private equity firms engage in practices that harm these objectives. From my experience as an institutional investor, there are several important challenges relating to private equity investments. In particular, the need for increased transparency and the need for reforms to ensure that workers, communities, and investors are protected from predatory practices. Before I go into further detail, I want to say that private equity is an essential part of our capitalist system. The idea of the industry is simple. Sometimes a company has room to grow and become more productive, but its current ownership is not in a position to capitalize on that opportunity. In this situation, it makes sense for an investment vehicle run by experts to pool private capital, to buy the firm and take it to the next level, and then to sell it. This generates a profit for private equity firms and their investors. It helps the company to grow, and it creates more economic opportunity for society at large. For investors like the Illinois Treasury, private equity provides an opportunity to further diversify our portfolios, to help drive economic development, to support small businesses, to expand the circle of opportunity to underutilize investment firms like those from downstate Illinois or those that are minority and women-owned, and to provide a competitive return within our overall portfolio. Unfortunately, as private equity has continued to evolve and become a larger and larger portion of the economy, it has continued to be regulated as though it was a boutique investment that only affected the ultra-wealthy. That means that predatory activities like opaque fees and pillaging assets and strategically using bankruptcy without regard for the well-being of workers and their communities and their pensions remains perfectly legal. And as long as these practices are allowed, they will happen. And as long as they happen, our communities are at risk. And that's why sensible reforms are needed to rein in harmful behavior by bad actors in the space. Let me talk for a little bit about fee transparency before I run out of time. There has been a significant increase in demand from public pensions to invest in private equity. It's no wonder. The asset class has had historic levels of fundraising and record amounts of distributions to investors. Private equity is unique in that it is rooted in a sense of long-term partnership, where investments are designed to mature in 10 to 15 years, if not longer. Fiduciary duty is the foundation of an effective partnership between general partners and limited partners in private equity funds. And this is especially important given that these investments are illiquid and currently require less transparency than other investment vehicles. And that brings me to a crucial point. There is a dire need for increased transparency and disclosure to help provide investors the necessary information to make informed decisions, including data on fees in a clear, complete, consistent, and not misleading manner, so that institutional investors like myself can better fulfill our fiduciary duties. I see my 5 minutes is coming to an end, so I look forward to any questions you might have.
So thank you very much, Mr. Treasurer. Appreciate your comments here today. And next, we have joining us virtually Ms. Shirley Smith, who is a former employee of Art Van Furniture in Detroit, Michigan, and who is also a leader with United for Respect. Ms. Smith, I'd like to recognize you for 5 minutes, please.
Thank you, Senators. Thank you so much for having me here. My name is Shirley Smith, and I live in Detroit, Michigan. For 23 years, I worked for Art Van Furniture, the last 9 as a sales manager. It was a job that I truly loved. Art Van was a family-owned business, and the company culture was centered around family. Employees were tight-knit, we had each other's backs, and there was real sense of community. I was a single mom, And I'm grateful for the support and flexibility I had at work so I could be there for my son while juggling a successful career. I had the opportunity to build relationships with my customers and earn a good living, making it possible to buy my own home and provide a good education for my son. Working at Art Van was like my own little slice of the American dream until the private equity firm T.H. Lee came in and broke up our family. Before T.H. Lee took over in 2017, Art Van was a successful company, reporting $800 million in revenue that year. Up to then, most of my colleagues would have told you it was a company they loved working for. But those last 3 years were hell. It wasn't obvious right away, but a lot started changing. We noticed our top company leaders being pushed out the door. T.H. Lee brought in people who didn't even know the furniture business, and orders started coming in slower. In hindsight, that was a big red flag. Sales associates work on straight commission, which only gets paid when the order is delivered, and customers' orders weren't being filled. Art Van's reputation was being destroyed right before our eyes. We had to start making up excuses to our customers, some of whom grew violent when they learned they wouldn't be getting refunds. One of my colleagues even had a gun pulled on her during closing weekend. T.H. Lee made us feel like liars and thieves, taking people's hard-earned money when they knew they were never going to get their orders. We stopped paying our bills on time and started cutting staff. For decades, Art Van had been a debt-free company that paid all its bills. Under T.H. Lee's ownership, Art Van racked up millions of dollars in debt to Wall Street banks and other deep-pocketed creditors. T.H. Lee even sold off Art Van's real estate to itself, forcing Art Van to pay rent on the same properties it once owned. By the end of 2019, under T.H. Lee's so-called leadership, Art Van was in the red, and it took just 3 short years for T.H. Lee to strip our company for parts. Then the pandemic hit. We first received WARN Act notices about our layoffs before the COVID-19 emergency order was issued in Michigan. So the bankruptcy and layoffs had nothing to do with the pandemic. But then, a few weeks later, Art Van changed their original WARN Act notice, citing COVID-19 instead. As a result, we didn't get any severance pay or benefits, nothing. Robbing the American workforce like this, hurting the same people on the front line who've been applauded as heroes for keeping our economy open, should be a crime. When we were told we'd be losing our jobs, we were promised a lot. We were promised health insurance after closing. We never got it. The only insurance I could afford charged me 10 times what I've been paying for prescriptions. I was unemployed for 5 months, and many times I had to choose between paying for my medications or paying other bills. We were also promised a retention bonus that we never got. Since my employment didn't kick in for 2 months, I had to take money out of my 401 to make ends meet, which I'm still paying taxes on today. Sadly, my story is not unique. Private equity has quietly taken over nearly every facet of life, from retail and grocery store chains to housing, healthcare, media, and more, turning the American dream into nothing more than a pipe dream for millions of working families. And T.H. Lee didn't only destroy us, the individual workers who lost their job. Every community within Art Van store suffered too. We had deep reach into our communities. We were one of the largest taxpayers for the city of Warren, where we were headquartered, and one of the largest contributors to our food banks. When the company went under, there was a terrible ripple effect of harm felt throughout the state of Michigan. I'm here today to show you the human toll of Wall Street's greed. Our elected leaders, each of you here today, I have to ask you, I have to ask you why billionaires should be allowed to do this and destroy the fiber of America. Why should this be legal? This is a sin, it is unconscionable, and something needs to change. Thank you for giving me the opportunity to speak with you today.
Ms. Smith, thank you very much for being with us today. We really appreciate it. And now we have in person Ms. Peggy Malone, who is a registered nurse at the Crozier-Chester Medical Center in Upland, Pennsylvania.
Thank you, Senator Warren and members of the subcommittee. I am the Vice President of Crozier-Chester Nurses Association. We're a local of PASVAP, and I am also on the executive board. I have been a registered nurse for 32 years at Crozier-Chester Medical Center. Being a nurse for me and my colleagues is a calling. It is a profession that we are very proud of, and private equity has no business in healthcare. They have destroyed our hospital. They have destroyed the fiber of what we are as healthcare professionals. Prospect Medical Holdings, which has 17 hospitals across the country, the owners, I can go on and on about the owners, Leonard Green, David Topper, Sam Lee, and what they have done. That's all public knowledge. You can find that out. You can get that information. You can see that it's wrong that our tax system should not be creating incentives for business practices and private equity firms. They should not be able to extract huge dividends from hospitals. They were given $173 million of COVID relief money, none of which we have seen in the hospitals. We take care of patients every day. And I understand some of you are very pro private equity. Well, I'm going to tell you that it wasn't. Families were not allowed in the hospital. You did not see what was going on in there during this pandemic. We served patients moldy bread during that pandemic. We were not able to give good quality care to patients. Patients were dying. They had no family. They had no one in the rooms but us. It was the nurses. It was the respiratory therapists. We were the ones that had to go in. We were scrambling for iPads so that families could say goodbye to their loved ones without having anyone in the room. We were their families. We were using poor quality equipment. I would have to try to straddle a urinal to collect urine from a patient's bag between my feet with a gown and a mask and all the PPE. Number one, we were wearing trash bags at a certain point because we didn't even have enough PPE. And this is how we were taking care of patients day in and day out. I left my family. I stayed at a house that the local college gave us because I was afraid to take it home to my family. I had my children at home who were having graduations and everything taken away from them, as all of my colleagues. And we went in and we did this job every day to the best of our ability with no equipment, with no PPE. We were afraid for our lives, and we did this job, and we did it every day for every single person in this country. We thought we were doing good. And you know what? Now we're the bad guys because we're speaking up, and we want to know where that money is, and we want to know how these private equity firms cannot take care of the patients that are in these hospitals. We don't have enough staff. We don't have enough equipment. We are fighting every day to give good quality care to patients, and we are not able to do it. We are not able to do it, and nobody was in there watching. There were no families in there. There was no one watching. It was just us, and we were watching people die. And so I can give you the statistics. I can talk about Leonard Green, and I can talk about all the things that are going on and all the tax credits and things that these companies are given. They were given pandemic money, and we have not seen one bit of it being spent on the patients. That is our goal. Private equity does not belong in healthcare. Our job is to do no harm. It is to do no harm. It's to care for our patients. That's why we got into this. And we will fight, and every nurse I know will fight. But what I see now, we're seeing the PTSD. We're seeing the nurses suffering. We're seeing the doctors struggle. What we saw was a war zone for the last 20 months, and it's not over. And we have not gotten support. We have not gotten support from our administration. We have not gotten the supplies that we need. We do not have the staff that we need. Private equity has no business in healthcare.
So thank you, Ms. Malone, and thank you for the work that you have done. I lost my brother early in the pandemic, and he had no one with him except the nurses who showed up to hold his hand. I appreciate all that you've done, and I know it's been hard. We now have our final witness, and that is Dr. Appelbaum. Dr. Appelbaum, could you please talk with us a bit?
Yes, thank you, Senator Warren, Senator Kennedy, members of the subcommittee. I'm very happy to be here to testify today. Private equity is a largely unregulated financial actor, and it is playing a growing role in both the U.S. Economy and in global economies. In 2020, global assets under management reached $4.5 trillion, and this is expected to double to $9 trillion by 2025. So it's a big and important player. In the U.S., private equity owns or backs 8,000 companies in every nook and cranny of the economy, in industries ranging from healthcare, as we just heard, to IT, to retail chains, to supermarkets, single-family rental homes, and payday lenders. They're in every part of the economy. The private equity industry and its companies employ nearly 12 million workers. Pension funds and other limited partners have been pouring money into private equity funds, seemingly unaware that it is really hard for any private equity fund to beat a booming U.S. stock market, and they have not beaten it. We find that the research has shown that the median private equity fund in every vintage since 2006 has just tracked the stock market. It hasn't actually beaten it. Yet fundraising by the largest private equity firms has reached stratospheric levels. It's not that investors in private equity don't see a return on their money. They do see it. However, the point is that they could have gotten the same return by investing in stock market index funds without all the risk. So that they're not beating the stock market is the point. You could have done as well in the stock market. The big private equity funds are just raking in money from institutional investors. In the last 5 years, Blackstone and KKR each raised more than $90 billion. This year, KKR has launched, and it was launching an $18.5 billion fund, $5 billion for its North America fund, and Carlyle has announced plans to raise $27 billion for its next fund in what would be the biggest private equity fund. It is not possible to take that kind of money, invested in, they have just a few years to deploy it, and to invest it in small companies. They invested really big companies, which do not give you much opportunity for turning them around. We've just seen the $38 billion purchase of Medline, a family-owned company, by private equity firms. You don't pay $38 billion for a company you think you have to turn around. With all that cash on hand, private equity is poised to buy up large swaths of the U.S. economy with no limit on how much debt they can lever on the company, with no limit on how much wealth they can take out, and no limit on how hard they can squeeze the employees. A study of examining private equity buyouts of public companies found that when private equity takes these public companies private, employment declines by 13% in just the first 2 years. Another study that looked at private equity buyouts that used a lot of debt found that the bankruptcy rates were as high as 20%. For affected workers, their families, and communities, this is devastating. But win or lose, the private equity firms always walk away with a profit. Thank you.
Okay, John. Well, I want to thank Chairman Warren and Ranking Member Kennedy for allowing me to go first and ask questions. Senator Warren will return promptly from the vote. Dr. Appelbaum, what do you believe to be the primary gaps in the regulation and supervision of private equity?
I think that there's little recognition that what were once just leveraged buyout firms have now really developed many, many avenues for making money and for participating in the economy. So it's not just leveraged buyouts. It's also the credit funds, which I think are playing a huge role in a shadow economy. So the credit funds, so back in 2013, the regulators said to the banks, really, you shouldn't put more debt on a company than 6 times earnings, because our research shows that when you go beyond that point, the company is very likely to default on its debts, to experience financial distress, and to even go bankrupt. So they put that out there. And KKR came along and it had difficulty raising the kind of money it wanted to put on a company that it was buying. And so it wasn't long before the private equity firms figured out they needed their own credit funds. And these credit funds, they act like investment bankers, but there is no banking regulation of them. So I think that's really a huge gap in our knowledge of what's going on. Private equity now has real estate funds. These real estate investment funds move back and forth. Sometimes they're publicly traded. Sometimes they're privately held by the private equity firm. They are playing a role that I think is little understood in the economy. I've been studying healthcare, and so I've seen their role there. When you say that a chain like Stewart sold its real estate to a real estate investment trust, that would be a company that would be something that moves back and forth without much regulation and provides a lot of money to operators to go out and buy up, in this case, more hospitals. So we've seen a buying spree of hospitals by private equity or formerly private equity-owned chains funded by the real estate investment trust. So they're in many aspects of the economy. We look to the SEC to say, well, shouldn't you be taking a look at them? But in fact, it's not just the SEC that needs to be involved. We regulate investment banks, and I think if these credit funds want to operate as investment banks, they should be regulated in the same way. And I think we need to know a lot more about the role of real estate investment trusts in the economy. They fly completely below the radar, but they fund a lot of the expansion that we see going on by private equity firms.
Thank you very much, Dr. Appelbaum. Now, if the treasurer is still on WebEx or Zoom, Treasurer Freebricks, I would like to ask if you could share your experience with private equity in terms of fee and expense arrangements, and do you believe these arrangements are adequately disclosed and transparent?
Okay, so my office experience is similar to what other institutional investors are recognizing, and that is, as private equity continues to evolve, there's a growing need for improved disclosures around direct and indirect fees, expenses, and performance-based fees, such as carried interest in particular. It's safe to say that investors such as ourselves or public pension plans would be greatly benefited from an increased level of disclosure and transparency between general partners of private equity firms and investors. Given that fees charged by private equity managers are among the highest shouldered by institutional investors, the lack of transparency represents a meaningful risk factor. It is necessary to ensure transparency for all investors and ensure investors can validate fees, but also understand if there are any potential conflicts of interest around certain fees that may be passed through to companies that may negatively affect our investments.
Well, thank you very much, Treasurer, and thank you for the panel. I would happily yield it back to my colleague from Louisiana, and I'm going to vote. Thank you, John.
Thank you. Thank you, Senator. Mr. Treasurer, I'm a little confused. As Treasurer, you invest in private equity, do you not?
That's correct.
And your concern we should all share, is you say the fees are opaque and there's not enough transparency.
Right.
Are you telling me that you make private equity investments as a fiduciary without understanding the fees? And if so, whose fault is that?
Yeah. We put a lot of time and effort into understanding these fees and working. but that adds increased cost to us. And there are also smaller pension plans out there that don't have the resources.
Well, why don't you just don't make the investment?
But oftentimes we don't if they're not willing to work with us.
So what's the problem?
Just as in other fields and other investment classes, the transparency has been helpful in bringing down the cost of fees. Things like mutual funds. We think we'd see improvements in fees with greater transparency.
But if I go to buy a car and the car salesman doesn't explain the details of the financing to me, I just walk away. I don't call for the federal government to take over every car salesman in America. What am I missing here?
Well, I'd say we're not calling on the federal government to.
These are two players in the financial markets. You're not required to invest in private equity. In fact, you breach your fiduciary duty to invest in private equity if you don't understand the fees, don't you?
As I said, we put a lot of effort and time into this. I'm the first one to note that we at the Illinois Treasury significantly increased our allocation to the private equity space, given the opportunities and our ability to manage risks.
Well, have you ever invested in private equity when you didn't understand the fees?
Never. I never said we didn't understand the fees. We are advocating for the elimination, not advocating for elimination of private equity. We're seeking reforms to make it easier for us to do our jobs, to stop abuses, to increase transparency, to help create more efficient markets and provide basic protections.
I understand. Have you ever invested in a private equity deal as a fiduciary, as a state treasurer, without understanding the fees?
We put a lot of effort into this, but that results in increased costs as well. And just as we saw public market...
I understand that. I heard you the first time. But have you ever invested in a private equity deal without understanding the fees?
No.
Okay. Let me ask... Dr. Holtz-Eakin, I've looked at this legislation. It'll gut private equity like a fish.
I think that's correct.
Now, what will that impact have on workers of America?
We know that, the private equity markets are very large. As David Burton pointed out, that this is an important source of capital. Capital is how firms invest in skills for their workers, technologies, equipment. It raises productivity, and that productivity flows into higher real wages. So you're really affecting the standard of living.
Is it going to cause layoffs?
Absolutely.
You get rid of private equity, whether you do it in a de facto or de jure way. You could abolish private equity. You could also regulate it half to death. No, regulate it completely to death. Mm-hmm. Now, if you do that, I know it's in vogue to talk about rich billionaires around here, but they comprise a very small part of the American free enterprise system. We're going to have massive layoffs, aren't we?
Yes. I mean, you need the capital to run the economy.
In fact, isn't that what free enterprise is, a marriage of capital and labor?
Yes.
Some of my colleagues think it's a zero-sum game. They think that the American economy is like it was back in primitive times. To take a Marxist approach, some of my colleagues think that the only value in an economy is labor. And if you make money in an economy, you have to make money. If you become wealthy, you do it by exploiting labor. That's not an accurate description of the American economy today. Capital joins with labor. And today they both improve their value. That's how we grow our GDP, is it not?
That's correct.
All right, do you disagree with anything I said, Mr. Burton?
No, the one thing that you didn't really mention is it's not just capital and labor, it's also entrepreneurship and innovation, and it takes capital to innovate, to acquire new technologies, and that's how productivity improves, and that's how wages go up. If you don't become more productive through technological innovation or better management practices, then you can't see wages go up over any extended period of time. I also think there's sort of everything you said is absolutely true with respect to private capital markets. If we were to restrict private capital markets, we would destroy the United States economy because they're the most important means of raising capital for businesses and particularly for entrepreneurship. There's a more narrow case of these private equity funds that are basically engaged in acquiring failing public companies.
Can I stop you because I'm way over time?
Yep.
But since Senator Warren's
Right.
coming back, do they have private equity in Cuba?
No.
Do they have private equity in Venezuela?
No.
If they have private equity in China, it's state-owned, right?
China's a little bit more ambiguous, but they're certainly restricting private enterprise.
So is that where we're headed here, to have government run private equity like President Xi does in China?
Yes.
Would this bill move us toward that end?
This bill would make private equity funds narrowly defined utterly uneconomic.
Now, my understanding of private equity is that you have a company that goes out and says, we're really good at investing money, and we ask you to invest your money, private investor, with us, the venture capital company. And in order to invest in that venture capital company, you got to be an accredited investor. I mean, you got to have a net worth and show that you're a sophisticated investor.
Generally, yes.
And then that private equity company goes and buys a private business. When it buys that private business, does it put a gun to the head of the owner of the private business and say you have to sell?
No.
So it's usually a voluntary transaction.
Yes.
And so now you've got a new owner of the business. Is that right?
Yes.
And that new owner tries to increase the value of that business because that new owner wants to make money. Am I right?
Yes.
Does it always work?
No.
If it doesn't work, who loses?
There can be a lot of losers. The
Right.
shareholders, the equity fund, employees, customers, vendors.
But if it does work, it's a beautiful thing.
Yes.
And we call this free enterprise.
Yes.
As opposed to government saying you can't invest there, but you have to invest there.
Right.
Okay. I went way over. That's okay. But I had to stall.
Are you good?
I'm done.
All right.
I'm going to go vote. Thank you all for coming today.
And thank you. Again, sorry about the confusion about all the things that are going on at once. Let me start. I'd like to talk about private equity and its impact on workers and communities. Ms. Smith, I think you're with us virtually. I want to thank you for being here today. Since you experienced it firsthand, I'd like your help in walking through how Art Van went under so that we can better understand the private equity model. So could you tell me, was Art Van profitable before it was acquired by THL in 2017?
We were. We had about $8 million in sales that year, and we literally owned about 55 to 60% of the market share in the furniture sales industry.
Okay, so this private equity company takes over this successful, profitable, I think you said 58-year-old company, saying they were going to make it more profitable. So let's talk about how they made it more profitable. Ms. Smith, once THL came in, what did they do first to supercharge Art Van's growth? Did they boost the marketing budget? Did they invest in retaining management? Did they start a staff training program? Did they build a new website? What did they do to help boost the profits? What did they do straight out of the chalks?
Straight out of the gate, the first thing they did was sell off all of the real estate. Art Van was a debt-free company. They owned the land that every building was on. The first thing they did was sold the real estate, made back the money that they spent buying the company, and then they started destroying the company. They got rid of all of our top leadership and brought in, as I said, people that didn't know the company, didn't know the furniture industry at all. They hired the worst CEO, someone that was rated the worst CEO in the nation in 2016 to run the company. And some could say he didn't do his job, but I'll say that he did his job very well. He was hired to run this company out of business, and that's what he did.
Okay, so let's talk through this. So this is a standard play out of the private equity book. THL put up very little of its own money. It took out a bunch of debt to buy Art Van, and then made Art Van responsible for that debt. Meanwhile, THL is collecting huge fees just for putting its own deal together. And then before the ink dries on that deal, Art Van, this once very profitable company, as you say, that had no debt, gets hit with now two big expenses. The new debt that THL put on the company, and now if they sell off all the real estate, it's not that they move out and shut down their business yet. It's that they got to pay rent on all the buildings that they used to own. THL, however, so Art Van is a whole lot worse off. THL, however, is a whole lot better off. They take some of that money from the buildings. They pay themselves back the money they'd originally invested in the deal, and then they just keep collecting fees on everything that's happening, including managing the rental property here. So now Art Van has its back against the wall. So let me ask you, Ms. Smith, at this point then, how did Art Van meet these new expenses? Did these investments in the business help boost revenue so they could offset these new debts?
There were no real investments into the company. THL took money out of the company and never put anything back in. They started laying off workers. They kept advertising. The one thing they did was they kept the advertising budget up, but that was to keep customers coming in, spending money. But where the money was going, we don't know. They said that we were losing money. However, even though our actual intake might have dropped in dollar volume wise, our profit margin went up.
Mm-hmm. So
7%. So when you talk about $800 million, 6-7% is a lot of money. So,
all right. Okay, but I take it what happens is they keep cutting the costs, and then Art Van gets into a situation because they no longer own their real estate. They now got to pay rent. They ultimately can't pay their bills. And so Art Van files for bankruptcy. That destroys about 3,000 jobs, and you and your coworkers were left without health care during a pandemic. Do I have that about right?
You have that right. They told us that we would have health care to the end of the month, and we didn't. They didn't give us the severance pay. They told us that we didn't get it because they didn't close because they were going out of business. They closed because of COVID. So, let me use this as a shield to change my attitude and change my dance so I don't have to pay.
Right. So
everything they did was to profit them and to hurt the people, and they didn't care.
Yeah. Well, one of the things that we often hear about from the private equity industry is that it's not in their interest to drive companies into bankruptcy. I think that was kind of the point that Senator Kennedy was making. And that cases like yours are unfortunate, but they're just part of doing business. They say that most businesses survive after being taken over by private equity, while only a few, like Art Van, actually fail. Do you find that a persuasive argument, Ms. Smith?
So I don't find it a persuasive argument. I know that THL didn't intend for Art Van to go out of business. They intended to take us into debt because that's the model. Let's take the company into debt. Let's suck everything out of it we can, take it into a debt, and then sell it to somebody else. However, Mr. Van's name was so golden that they were able to borrow so much against this company that they couldn't sell it. They took this company so deep into debt. And, I keep hearing the senators talk about capitalism, and this country was built on capitalism. And yes, it was. It was built on the capitalism, But this is cannibalism. It is not capitalism. This is cannibalism. They are going in and they are stripping, destroying, and they don't care. They're plundering and leaving dead in their wake, and they don't care.
Well, what really troubles me here is that private equity has worked out a business model that helps them get rich at the expense of workers like you and your families. The model is pretty simple. They gamble with other people's money. They squeeze out what they can. They cram their pockets full, and then they bail, leaving workers and communities to deal with the fallout. So let me ask you, Dr. Appelbaum, how would the Stop Wall Street Looting Act help address these market failures? Is your mic on?
Yeah, thank you. So it's very clear that the Stop Wall Street Looting Act would play a role in these kinds of situations. It would require that the private equity firm keep some skin in the game. It would reduce incentives for them to load portfolio companies with excessive amounts of debt. Obviously, reasonable amounts of debt are not a problem. It's as our speaker just described, the amount of debt that they put on that company is what the problem was. And so it protects companies from bankruptcy. The act includes protections for workers in the case of bankruptcy, severance pay and other protections. And it also increases transparency. The institutional investors in these private equity funds have little to no information about the companies that the fund has acquired. And this would provide them with some information, break out that asymmetrical situation. And in my opinion, it would stop the worst abuses and encourage private equity to do what it says it does and help companies to grow and be successful.
Thank you. Thank you very much, Dr. Appelbaum. I'm just going to go to another round of questions since like I said, we're in a little mix and match here. What I'd like to talk about now is what happens when companies buckle under the weight of private equity debt and mismanagement and go bankrupt, and how workers and their families and communities have to deal with that fallout. We understand, and that's what happened in Art Van, that particular version of the problem, but even when companies don't go under, the consequences of the private equity playbook can still be devastating. In the worst cases, as we've seen with private equity's involvement in healthcare, people get sick and they die. So, Ms. Malone, you have been a registered nurse at Crozier for more than 30 years. Your hospital was acquired by Prospect Medical, which was owned by the private equity firm Leonard Green in 2016. Did you notice a change when private equity took over?
Yes, almost immediately. We immediately saw staff was cut. We were unable to get supplies. We were told by vendors that bills had not been paid, and that's why we were not able to get supplies. I work in the substance abuse department. We were not able to have our acupuncturists come, our music therapists. They had not been paid in several months, and they were going to be unable to continue to come and provide their services to our patients. And we saw that happen pretty quickly. Staff was at a minimum, and the quality of the supplies, which when you have poor quality, it takes several more attempts to put an IV in. You're increasing your rate of infection. When you have poor quality Foley catheters, your instance of infection goes up. And so all of these things result in death. You have the potential every time you make cuts in staff when you are giving nurses more patients than they're safely able to handle. You're just increased. We are constantly putting patients at risk. These are people's lives that we deal with. Workplace violence has increased. The people who are waiting, when you have 20 people over above what your emergency room holds waiting to be seen, the staff we're abused, we're physically abused, we're verbally abused. I mean, the trickle down of the cuts that this company made almost immediately, we're still feeling. And unfortunately, the pandemic happened. And so everything is being hidden under the guise of this pandemic. These things were happening long before the pandemic, and they're using the pandemic as an excuse that there's a nursing shortage, that we can't get supplies, when the reality is they're not providing us with what we can have. There isn't a nursing shortage. There is a shortage of nurses who are willing to work at the bedside under these kind of conditions. We take an oath to do no harm, and we are no longer able to do that. Nurses are fleeing. I can tell you of 20-plus nurses who have left Crozier in the last 2 weeks.
Mm-hmm. So you're saying here, just so I can get this together with private equity, so they cut staffing, cut supplies, that reduces the quality of patient care, and in fact increases infections, ultimately mortality rates. Talk to me just a little bit, though, about other parts out of the playbook. For example, what did they do with the real estate in your case? So they did sell the real estate, and so they, once again, they made a large profit. Leonard Green took $400 million out of Prospect Medical. So they took how much money out of the $400 million? So they take $400 million out. Correct. While they're laying off people, shortchanging you on supplies. Yes. They took all of that money, and they had made a commitment. They had made a commitment to make a $200 million investment in our hospital as part of the acquisition deal, and none of that has happened. None of it happened. This is not a business model. This is looting. It is. And unfortunately, we're seeing it all around the healthcare sector, including, as COVID has made painfully clear, at nursing homes. Private equity firms have been buying up nursing homes, and the consequences have been deadly. Researchers have found that private equity ownership, quote, increases the short-term mortality of Medicare patients by 10%. End quote. That implies that more than 200,000 people died between 2000 and 2017 simply because they lived in a nursing home that was owned by a private equity firm. So, Ms. Malone, from what you've experienced with private equity at your hospital, does the fact that private equity ownership has been found to kill people in nursing homes surprise you? No, it doesn't. It doesn't at all. Private equity firms are focused on making the biggest profit. They're not focused on providing the best care. And I don't ever see how their incentives could be aligned with patients and staff. It just doesn't work that way. These are people's lives. Right. I think I misspoke on the number of deaths. I think I looked down and said 200,000 instead of 20,000. One death is one death. It's too many. Too many. So this is one of these things we need to act. And this is why I've introduced the Stop Wall Street Looting Act, so that we can better align incentives between private equity and the companies they take over by restricting the ability of private equity to buy a company and profit from running it straight into the ground. This is a bill that would ensure that private equity has skin in the game, as Dr. Appelbaum was talking about, because if private equity has skin in the game, maybe they will think twice about their actions, especially when their looting leads to increased illness, suffering, and death among our most vulnerable people. So thank you very much, and thank you for being here. I appreciate it, Ms. Malone. Shall I do another round of questions? All right. Right here. Here we go. All right. This is what happens when you get out of order here. You guys just have to take me straight through on this. So I want to talk about the returns. Let's talk about the financial part of this now, the returns from private equity investments. After all, private equity keeps scooping up money because they promise super high returns, higher than more traditional investments like stocks and bonds. In fact, That's why giant private equity firms get the big fees. They supposedly deliver big returns. Strong and steady returns are important. Public pension funds and retirement security of teachers and firefighters and local government employees across the country depend on these returns. So it's no wonder that pension funds and other institutional investors would find private equity's promises so very attractive, and why they might be willing to tolerate the risks and even the consequences that we've talked about today. So let's start with the data. Dr. Appelbaum, you've studied market returns in detail. This is pretty much your specialty. So let me ask you, does private equity outperform the market?
No, it doesn't. And there are quite a few studies now that show that the returns basically, well, let's be clear. Since 2006, it's the median private equity firm in each vintage launched since then that has just about tracked the market using the metric that the finance professors would use, which is the public market equivalent. Mm-hmm. Nobody who studies private equity uses the internal rate of return, which is what is used in the industry, and which is quite misleading. You never get the amount of money that the internal rate of return suggests to take to the bank. That's not money you can take to the bank. If we have time, I can tell you all about what's wrong with the IRR, but what the researchers used at the public market equivalent, and what they find is that since 2006, the median fund, the typical fund, has not outperformed the market. That means half of the funds are underperforming the market. Right?
So, but that means for 15 years now.
Yes.
I just want to be crystal clear on this. For 15 years, the typical private equity fund has failed to outperform the stock market, which sounds a lot like private equity has been fooling everyone for the past 15 years. So let me ask Dr. Appelbaum, if the typical private equity fund is not generating the returns that the private equity industry claims it does, then what are the investors paying for?
Yep, that's a very good question. And of course, as you know, they are paying billions of dollars in fees. I mean, those fees really add up. So I'm just going to point to a study by Oxford University finance professor Ludovic Philippou. He calls private equity funds billionaire factories. They produce little for investors, but they make the private equity firm partners billionaires.
Wow. So teachers and firefighters are being asked to take money out of their retirements to pad the pockets of private equity billionaires, and they aren't even getting the above average market returns that they thought that they were paying for. Is that a fair summary?
It is definitely a fair summary, and you have to remember that these are risky investments, and the idea at the beginning was that they would get a return that was 3% above the market to reward them for the risk that they're taking.
Okay.
And now they get no premium whatsoever.
Okay, so they're getting no premium, but they're taking on more risk. So we have a chance here now to talk with the treasurer of the #1 state employee pension fund, the fund that is doing better than any other public employee pension fund. I mean, hurrah, right? This is not the one in the middle. This is the one way down on the top performing end. Treasurer Frerichs, you have been doing very well with private equity. Is that a fair statement?
Yes, that's correct.
Good. And you are an investor. That is, you manage a pension fund on behalf of your office. You are a trustee for a public pension plan that invests in private equity on behalf of teachers and firefighters and other public employees. So the question I want to ask you, as an investor, you're on the side that's trying to make money out of this. Are you satisfied with the current rules governing private equity, or would you like to see some new rules in place requiring transparency about fees and aligning the interests of PE managers with their investors.
Yeah, I'll just say that PE has done well by us, but it would be beneficial to see new rules and sensible reforms. For example, standard reporting would ensure transparency for all investors and ensure investors can validate all fees charged by private equity, that they conform with their negotiated agreements. That would be one good reform. Our office does its due diligence. Senator Kennedy asked if I had made any investments without that. No, we do our due diligence, but for us and many of our public fund peers, there is difficulty receiving proper disclosure and transparency around direct and indirect fees in a clear and consistent manner. There's been characterization that we're heading towards socialism here. I believe in the market here, and I believe the markets work well and efficiently with proper access to information. This opaqueness makes it difficult to shop around and determine whether we're getting a competitive rate. Now, he's right. If we're buying a car and someone wouldn't disclose to us, we wouldn't want to buy there. But sometimes they will just flood you in information and bury things in that sale document at that car dealer. And we regulate car dealers to make sure there's proper disclosure. Without proper disclosures, tracking of fees and expenses charged by a private equity firm is a cumbersome process, and markets shouldn't be cumbersome. This can then potentially enable firms to hide and shift fees, potentially manipulate returns reporting, and avoid disclosing certain deals. Ultimately, I believe new rules would be valuable.
Yeah. So as I understand this, you're saying you like the market, but it's very hard for you to be able to see what you're paying in fees. And if that's hard, that means it's very hard to make comparative judgments. And I just want to emphasize here, you're not one of the little funds. Am I right on this? You have a pretty big shop there.
Correct. We oversee tens of billions of dollars in investments, and between ISB and internal, billions of dollars in private equity. So we have resources here, but still, in order to use those resources to try and sort through all this, it costs us extra money. And smaller pension funds don't have the resources that we have.
Yeah, I think there's just a really important point about markets. If we want markets to work, then people have to have consistently reported information so you can get comparisons across them, and the information has to be made available. I appreciate your testimony on this. My Stop Wall Street Looting Act would require private equity funds to clearly disclose their fees and returns so that public pensions and other investors have the information that they need in order to make informed decisions. America faces a retirement crisis, but the solution is not to squeeze employees more or to cut retail jobs and wages or to undermine the health and safety of people in hospitals and nursing homes. The solution is to put stronger rules in place that investors and retirees and families don't get gouged by private equity firms that are trying to fleece them. So to me, that's what this hearing is about today. Since I didn't get to do an opening statement at the beginning, I just want to do a kind of overview as we wrap this up and say thank you to everyone who has been here. This is the first hearing that the Senate has held that is focused entirely on private equity. And it's about time that we do this. We need to get the facts on the table about what private equity firms are doing to our economy and to our communities. Private equity firms have plenty of money to spend on lobbyists and PR campaigns. They have their own trade association, which I know has been making the rounds in Congress ahead of this hearing. They have worked hard to portray themselves as good actors that bring jobs and investments to communities in need, and they have no problem telling their version of the story. But their version of the story glosses over a lot of what happens to local workers, to local businesses, to local communities when some private equity firm waltzes into town. Once private equity starts buying up local stores or hospitals or newspapers or prison commissaries or for-profit colleges or nursing homes or hospitals or any of dozens of other industries, the smiling private equity managers and their secret investors profit hugely, while workers and local businesses and local communities too often come out as the losers. In 2019, I opened a broad investigation of the role of private equity in the economy, and this investigation exposed how the industry is fundamentally broken. Private equity relies on a business model that pays managers to go after short-term profits, charging huge fees even as they destroy the long-term prospects of the businesses that they buy. It is bad for workers and bad for consumers when local retailers or even large chains are bought out by private equity. These firms load up the target company with debt, as we've seen the examples here today. They strip out assets, and the next thing you know, thousands of workers have lost their jobs and the stores are shut down. It's also bad for seniors and their families when private equity firms buy up nursing homes and other healthcare providers. It's the same pattern. Assets are stripped out, cost-cutting runs rampant, and the quality of care declines with real consequences for people's health and for their lives. It's bad for students when private equity firms buy up for-profit colleges. The industry already has a bad record of ripping off students, and private equity just makes it worse. It is bad for communities when private equity firms buy up thousands of manufactured homes and the land that they sit on. Costs skyrocket, forcing residents to choose between paying the rent and paying for basic necessities like food and medicine. And meanwhile, the investments in these communities decline and conditions get worse and worse. And by the way, we will be hearing more about that particular abuse of private equity in the housing sector tomorrow at the Banking Committee hearing, and I'm looking forward to joining Senator Brown on that. What I see here is across the board in industry after industry, it's the same pattern. Private equity executives make off with massive short-term gains, and they leave workers, consumers, communities, and ordinary investors with pretty much nothing to show for it. And all of this has been magnified during the COVID pandemic. The companies that are owned by private equity firms have received over $5 billion in taxpayer money from the CARES Act. I appreciate your pointing it out in your case, Ms. Malone. Their record has only gotten worse. Private equity-owned nursing homes had a terrible safety record before the pandemic. Private equity-owned retailers were weighed down with debt and shut their doors for good. Private equity landlords laid in wait for the eviction moratorium to end so they could make more money, even if it meant kicking families out of their homes. What almost every American experienced as a crisis, private equity viewed as an opportunity. And I know we've heard from the private equity industry in response to this hearing. They say this is all for the best. We hear about the standard talking points that private equity firms employ millions of people and create big returns for pension funds for teachers and firefighters. But when you fact check those claims, it just turns out they're not true. In fact, private equity investments often result in fewer jobs and lower wages. And despite how hard they squeeze the businesses they acquire, private equity doesn't offer an above-market return to investors. So what are we going to do about this? Well, I want to set some minds at ease. I don't want to eliminate private equity, but I do want to fix it. And that's why I've introduced the Stop Wall Street Looting Act, which is groundbreaking legislation to clean up this industry. My legislation aims to make the entire industry more transparent and to end the misaligned incentives that create private equity's heads I win, tails you lose business model. So I appreciate all of the witnesses who joined us today. I very much appreciate the firsthand accounts that you've given us about what it is like to live through this on the receiving end as an employee. I appreciate the academic perspective that's going on. I very much appreciate the treasurer joining us and telling us what it's like as an investor, even someone who's done well with private equity, how we could make improvements that make this market work better. So thank you all for being here today. Thank you for providing testimony. Before we go, I'd also like to submit a statement for the record from the Private Equity Stakeholder Project for senators who wish to submit questions for the record. Those questions are due 1 week from today, which is Wednesday, October 27th. I also want to enter into the record a statement from my friend, Senator Baldwin, who has been a fighter for the workers and the communities of Wisconsin in the face of predatory private equity abuses. And so thank you, Senator Baldwin. We'll make sure that is entered into the record. And for our witnesses, you'll have 45 days to respond to any questions. Thank you all very much. And with that, this hearing is adjourned. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.